As the Reserve Bank of Australia decided to hold interest rates, expectations for rate cuts have been pushed further in 2025. High interest rates put immense pressure on repayments, dragging the Sydney housing market into a downturn since October. Meanwhile, the Melbourne property market has been experiencing steady declines for over a year. Property investors in these two cities have lost patience and started selling off their investment properties, weakening the overall Australian real estate market trend. However, there are three Australian cities that are set to weather the market cycle, and one city in particular is expected to see a housing price surge in the near future. Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. On November 6th, the Reserve Bank of Australia stood firm against mounting pressure and chose not to cut interest rates. Inflation has yet to fall within the target range of 2 to 3%. While goods inflation is under control, service inflation remains high at nearly 5%. Coupled with steady unemployment, I'd say there's no rush to cut rates. The evening the RBA announced its decision, I'd predicted that the big four banks would soon adjust their rate cut expectations. Just a few days later, NAB was the first to revise its forecast, pushing the anticipated rate cut from February to May next year. Their reasoning? While inflation is trending down, the RBA remains cautious about vulnerable sectors like wages, consumption, and the global economy. In other words, NAB believes the RBA is holding back to create more room for future rate cuts. This outcome was predictable. What's surprising is that the other three banks in the Big Four still did not follow suit, maintaining their forecast for a February 2025 rate cut. Some banks, like HSBC, even predict that the RBA might hold rates steady for 2025. The current market is filled with uncertainties, and one more has been added post-US elections: the tariffs set to take effect next year. These tariffs could drive up global inflation and interest rates. For details, please check out episode 063. For homeowners, this delay has some tangible costs. On a typical $600,000 mortgage with a 25-year term, a May rate cut instead of February would mean an additional payment of $2,000 in interest over 2 years. At the end of 2023, banks initially predicted a March 2024 rate cut. That was pushed to September, then February 2025, and now May. Over this extended period, property investors have been shouldering the burden of high interest rates. However, with rent growth nearly stalled, certain suburbs with concentrated new immigrants and international students are seeing falling rents and rising vacancies, intensifying repayment pressures. More investors are losing patience and choosing to sell their properties to cut losses. The most immediate response to the current market conditions has been a surge in property listings in Sydney and Melbourne. With the interest rates remaining high, many homeowners are feeling the intense pressure of repayments and are left with no choice but to sell their properties. This has made Australia's spring selling season see listing volumes far exceed the average of the past 5 years. These properties, known as distressed listings, are properties that owners are desperate to offload before they hit the breaking point. As the number of these properties grows, buyers now have more choices than ever. CoreLogic data shows that Melbourne's total listings are 10.1% higher than the spring average since 2019, while Sydney's are up by 12.3%. Melbourne's property market has been in a steady decline for over 12 months, while Sydney only began its downturn in October. In such a market, even managing to sell at auction is considered a success. If a property sells for much higher than the reserve price, it can inject much-needed confidence into the real estate market. Melbourne, currently the weakest housing market in Australia, recently saw a 4-bedroom terrace in the southeastern suburb of Prahran sell for $5.7 million, exceeding its $5.2 million price guide. Over the past year, many high-end properties in Melbourne failed to sell at auction or stalled in post-auction negotiations. Now similar trends are emerging in Sydney, with increasing cases of properties passing in at auction, failing to enter negotiations or receiving no interest at all. For Sydney and Melbourne investors who are burdened with larger mortgages, hope for a rate cut in early 2025 has faded, leaving many to give up. Instead of holding on to the properties, they are rushing to sell where prices remain relatively high and before a significant downturn sets in. In October, distressed listings in Victoria surged by 5.6% to 1,104, surpassing pre-pandemic levels for the first time. Sydney is also seeing a growing number of distressed listings. It's important to note that not all distressed listings are newly listed properties. Some have been on the market for a while but failed to sell, leading desperate sellers to lower their expectations drastically. You might just snag a bargain if you can find one of those properties. We all know apartment prices usually rise slower than houses. However, when a downturn hits, house prices in some suburbs could fall even faster than apartments. According to CoreLogic, in the past 3 months, house prices have dropped in 40% of Sydney suburbs, the highest level in 20 months. Meanwhile, in Melbourne, the proportion of suburbs with falling house prices has skyrocketed to 76.3%, 6 times higher than last year. In Sydney, the sharpest house price drops over the past 3 months were seen in Zetland, down 10.1%, Rosebery, down 9.1%, North Strathfield, down 7.3%, Balmain East, down 6.9%, Glebe, down 6.5%. Melbourne is also struggling, with notable declines in Albert Park, down 9%, South Melbourne, down 8.6%, Port Melbourne, down 8%. As market inventory increases, borrowing capacity weakens, and housing affordability worsens, the downward trend in the property market is spreading. Melbourne's decline is relatively moderate, while Sydney is in the early stages of a downturn. With rate cut expectations being pushed further into the future, this downward trend is likely to persist in the coming months until a major shift occurs in supply versus demand or their underlying factors. For instance, the Australian Labor Party has proposed capping new international student intake at 270,000 in 2025, a 23% reduction from 2024, and on par with pre-pandemic levels. This is in response to Australia's high cost of living, where locals blame immigration, including international students, for unaffordable housing prices and rents. Reducing student numbers has become a priority for the government. Rumors of this proposal have circulated since May, prompting many universities to downsize their teaching teams. Traditional hotspots for new immigrants and international students are already seeing house prices and rents affected. However, a twist has emerged. What was once an agreement between Labor, the Liberal Party, and the Greens is now in question. During the Senate's second reading debate on November the 18th, the Liberals and Greens opposed Labor's proposal to cap international student numbers. This opposition could derail the proposal entirely. What investors fear most is not rising or falling prices, but uncertainty. Whether the cap on international student passes will directly impact Australia's education sector, employment, and most importantly, property investors. Housing prices and rents in immigration and student-heavy areas will be affected. The outcome of this proposal is unknown till sometime in 2025. This is just one factor affecting the balance of supply and demand in the property market. Other factors, such as the federal election in May and domestic migration trends, add further layers of uncertainty. While Sydney and Melbourne are clearly in decline, 3 smaller cities among Australia's 8 capitals, Darwin, Canberra, and Hobart, are in a state of fluctuation. These markets see prices rise by 1% one month and fall by 1% the next. Canberra stands out with a more consistent trend, experiencing 3 consecutive months of slight declines. Historically, when Sydney and Melbourne enter a downturn, Canberra, sandwiched between them, usually follows suit. Australia's overall housing market is visibly weakening. Looking at the 3 mid-sized cities, Brisbane, Perth, and Adelaide, this trend becomes more evident. These cities are still in a growing cycle, but the pace of price increases has slowed over the past 3 months. They haven't entered a downward phase yet. They remain further from the risk zone, making them the likely stable performers in the broader market trends. Once interest rates begin to drop, Sydney's housing market may rebound quickly. If rates decrease in February, the Sydney property prices haven't fallen too far by then, its recovery could be swift. Melbourne, on the other hand, might require more time to stabilize, falling more gradually, finding its bottom, and then beginning to rise. Typically, the longer the market trends downward, the longer the rebound takes. Sydney's last downturn, triggered by rapid rate hikes in 2022, lasted 12 months, with prices dropping by 12.4%. It then took 15 months for the prices to recover to the new highs in June 2024. That V-shaped cycle was deep, primarily due to uncertainty about how high rates would go and widespread fears of a property market crash. This time, however, the situation is different. The market is certain that rates will eventually drop next year, though the exact timing remains uncertain. This suggests Sydney might rebound earlier than Melbourne. Australia's Prudential Regulation Authority, which oversees bank credit risk, triggered a housing market downturn from 2017 to 2019 by forcing banks to tightening lending policies. That downturn lasted 23 months, but it took just 9 months for price to recover to record highs afterwards. The link between interest rates, credit availability, and price trends is clear. How much will rates drop in the next easing cycle? If the RBA only reduces rates by 0.5%, the improvement in housing affordability will be limited. A significant, rapid price rebound would require a larger rate cut, perhaps as much as 2%. Achieving such a substantial reduction might need an economic recession or a surge in unemployment. For example, following the 2008 financial crisis, the RBA made 6 rate cuts, bringing rates from 7.25% down to 3%, which stabilized the economy and caused a housing recovery. Without a major crisis, the RBA is likely to cut rates cautiously and gradually. This would reduce the likelihood of rapid price spikes, paving the way for a steady market with moderate growth. Combined with government initiatives to improve affordability such as the Federal Shared Equity Scheme, Queensland's Housing System Program, and Victoria's stamp duty reductions, price growth in the mid to low-end housing sector could outpace the high-end market. For investors, the key is to assess your budget and identify value opportunities within your price range. Once you've found a property, buy it, hold it, and resist the urge to sell. With a long-term perspective, you will get steady returns. Where can you find value now? That's right, Melbourne. Currently, Melbourne's average property price ranks as the 3rd lowest among Australian capitals. Cities like Sydney, Canberra, Brisbane, Adelaide, Perth, and even the Gold Coast are more expensive. While it's understandable that Sydney and Brisbane surpass Melbourne due to the growth and demand, it's hard to justify why Adelaide is pricier. Think about it. If you live in Adelaide, where property prices are higher than in Melbourne, but job opportunities, career prospects, and salaries are all better in Melbourne, why wouldn't you choose to move there? The cost of living is similar, but Melbourne offers a better lifestyle overall. This undervaluation in Melbourne suggests that once the current downturn stabilizes, Melbourne's property prices could rise more sharply than other capitals. Critics of Melbourne property investment often argue that the city's economy is weak, its government burdens investors with excessive taxes, and property supply is too much while population growth is slower. However, once interest rates begin to fall, especially with consecutive rate cuts, the cost of investing in Melbourne properties will drop significantly, boosting buyer demand and driving prices up. In the medium term, Melbourne's market performance could very well outpace other cities. Since March 2020, Melbourne's property price growth has lagged behind other capitals, much like Perth after 2010. However, as we saw in Perth, once the market caught up, property prices have surged explosively since 2020. Similarly, price adjustments between capitals follow a ripple effect. When one city becomes too expensive, buyers turn to more affordable alternatives. In the short term, Melbourne's market might remain weak, but its long-term potential is undeniable. Investors can generally be categorized into 3 types. Number 1, buy when prices rise. These investors need immediate gains, quick price appreciation, strong rental income, and positive cash flow. They represent 95% of the investors I've met over the past 18 years, driven by a desire for instant results. Number 2, buy when prices fall. This group sees opportunities in discounted properties, buying low with confidence that the prices will rise later. They are rare breed, making up about 4% of investors, as they've overcome the emotional hurdles of investing against the trend. Number 3, buy what fits their plan. Regardless of market trends, these investors focus on long-term wealth and life goals. Knowing that Australian property generally appreciates over time, they buy, hold, and don't sell, remaining passive investors with the freedom to enjoy life. This category accounts for just 1% of investors. At Oz Property Strategy, most of our Vision members fall into the 3rd group. We provide tailored investment strategies, mortgage planning, wealth management, legal and accounting support, and property management services, all under one roof. This allows members to enjoy passive income while living life to the fullest. Over the past 4 years, none of our members have experienced investment losses, not even on paper. And even if paper losses arise in the future, holding the property long term makes substantial gains a high probability. If you made it this far, please give me a thumbs up, subscribe and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.